Should you really be worried about sequence of return risk? All right, I'm going to show you why you shouldn't worry that much about it. All right, that doesn't mean you don't worry. Look, I'm from an island. I was raised on an island off the coast of in Casco Bay, Maine. All right, Mainers by nature are cautiously pessimistic, and if you're raised on an island and you have to take a boat back and forth to town, all right, inherently you're going to be a cautiously pessimistic person. That's just where your old buddy Josh is. All right. So with that said, this is one of those risks that I think is way overblown, way overblown. I'm just going to dive into my man Daniel Colbert's 55e.co stuff here. And we're going to look at the bucket strategy, which you can download for, well, not for free. It costs $35 from Daniel's bucket strategy. It's updated a lot of it for 2024 now, which is pretty sweet. It's one of the best programs I know out there. It's basically three. My man Craig Israelson's over at 712portfolios.com. I can't remember 712 portfolios or 712.com. I forgot. His retirement portfolio analyzer, I like a lot. Daniel Colbert's 55E bucket strategy, I like a lot. And then, of course, just my old-fashioned Bright Capital software. All right, so check this out. We're just going to look at simply, we're going to look at the S&P 500, and we're going to go back to 1871, and we're going to say how many sequence of return risks do we have? When I'm saying sequence of return risk, I'm talking about extended portfolio decline of more than 2 years, of 2 years or more, 2 years or more, consecutively, 2 years or more. Now, this is just on calendar years, all right, calendar years. So we're just saying 1871, 1872, 1873, 1874, that such, all right? So that's what we're doing here. We're not doing any 12 to 24-month time. We're just doing calendar for initially. So check this out. So we go back to 1871. We see right here. In 1876 and 1877, we had 2 consecutive down years. Oh, but look, 1877, we had deflation that was more than the loss of the S&P 500. So essentially, the S&P 500 was up in 1877. So we don't have 2 consecutive years here, do we? No. So we go to 1883 and 1884. Yeah, a couple. I mean, you got negative 5.5 in 1883 with a 1% deflation, 4.5 rate of return. 12.3 is the loss in 1884 with a 3% deflation, so it's a 9.3. And I wouldn't consider that a huge sequence of return risk. Then you got right here, negative 0.6. Okay. And then you get with the inflation, you got it again. I mean, these are not consecutive. Other than these 2 years, they're just not consecutive. They're just not. It was down 18.8% in 1893. So essentially, basically for the 30 years from starting 1871 to the year 1900, we had 2 sequence of return risk consecutive. And again, one of those is even suspect. We put an asterisk by like Barry Bonds' home run record because his deflation topped that of the rate of return loss. All right, so now we go to nothing here. 1903, you lost 17%, but you gained it all back essentially in 1904. 1907, you lost 24%, but you certainly gained it all back in the next 2 years. So it's not a sequence of return risk. All right, now we got 1913, the start of the Fed, the start of the ADL, the start of the IRS, I think that's the FBI too. So here you go, sequence of return risk. But all in all, we're down 10 to 11% when you factor in inflation, maybe 12%. Not a huge issue there. All right, and you picked it all up again the following year anyway, so just not a big deal. Here in 1917, the start of Woodrow Wilson's war, we were down 18%, but we made it back roughly the next 2 years. We're down 14% in 1920. We made it back the next 2 years. So again, not a sequence of return risk at all, just not. 1 year is not a sequence of return risk. Now we go to the 1930s, and you can see here again, this is the big one everyone freaks out about. And we're down 25, 1931, 43, but we had a 9% deflation. So this is a big deal. I'm not denying that we had a sequence of return risk. But really, the only sequence of return risk in the first 75 years of the market was in the Great Depression. From 1929 to 1937, we got smoked. No 2 ways around that. We got smoked. That's just a fact. So that was horrible. And you did have a massive sequence of return risk, but it took 75 years for one really to show his face. And then we're going to go all the way, and again, 1939, 1940. Yeah, I mean, you could call that a sequence of return risk, I suppose. But I mean, okay. I mean, 4%, 10%, 11%. I mean, it is down 100%. But this isn't anywhere near down 2001, 2001, and 2, where it's down 9, 11, and 22%. So again, a sequence of return risk, sure. So we have the Great Depression, beginning of FDR's war, that we should never fought as well. But you can see right there, we have that time frame. Again, so now we're 75 years into retirement, essentially. We've had essentially 2 sequence of return risks, 1 massive decade of a sequence of return risk. I'm not going to deny that. There was one. Okay. Now we go 1946, not a sequence of return. 1954, no. 53, not a sequence of return risk. 1957, no. 1962, no. 1967, no. 1969, no. But this is a sequence of return risk right here because we also have to factor in the pretty significant inflation. So 73, 74, and 77, I would consider a sequence of return risk as well. All right, so now we're 106 years in retirement. We basically had 3 sequences of return risk of any significance. And that's, again, you could say the 2 in the 1800s were significant. I don't think they were, but okay. So we're just not going to, I'm not going to consider those significant sequence of return risk. But we do have one in the 1930s to basically 1942. We have one 1973 and 74 all the way through 1977. So you can see that. That's pretty significant because of the inflation. So we've had 2 significant sequence of return risk. Yeah, probably 3. We can say 3 because right here, we got 19 right here, 39, 30, 40, 41. That's the sequence of return risk right after the sequence of return risk of 1929 and 1932. That reminds me a lot, and I've done videos on this, how similar this decade was to the aughts of 2000. And that's it. There's no more sequence of return risk until we get to 2001 and 2. Almost identical to what happened in 1930. 9, 12, 22. That's a sequence of return risk. Now, 2008 was a sequence of return risk, A, because we had the worst year ever when you factor in inflation right there. But on top of that, it went from October 2007 to March of 2009. It was down 57%. That's definitely a sequence of return risk. No two ways around that. So that was, even though it's just one calendar year down, it hit hard. And that's it, man. Look, no other sequence of return risk. And this is 20. Let me go to, hold on a second. Let me go to 2020. We'll start right there, and it'll go to 2023. Does it go to 2024? Oops, I did think it does go to 2024. Let's see. Yeah, 2024. So that's not a sequence. 1 year I don't consider a sequence of return risk. I just don't. All right, now that is full 1 year. Don't get me wrong, but I don't consider that a sequence of return risk. That's enough. You'd want at least a 2 years cash. You'd be fine. Anyway, sorry, you're really looking at sequence of return risk the way you should. Now, let's look at Wellington. We'll go back to Wellington. And the reason we use Wellington is not because I love Wellington. I do like Wellington. I'm not going to lie to you. But it's the only fund that we have that gives us real performance numbers that goes back to 1930s. There's no other fund that does that because it has bonds. MFS, the Massachusetts Mutual Fund, has numbers that go back a little bit longer, but it's all stocks. There's no other stock and bond fund that has a track record of Wellington that we can see, net of fees and everything. So we can look at Wellington. We can say how many sequence of return risk did Wellington have. And we're going to have, you see right here, starting in 1930. This Wellington. Let me put Wellington right there. Boink. Wellington. And right there. All right. So you can see Wellington. It started, Wellington, right there, 1930, 31. That's a sequence of return risk. Absolutely. Oh, but look. Remember the sequence of return risk that happened the next decade from 1930, 40, 41, and 2? It didn't happen here. I would consider that's a sequence of return risk right there. 1937, I would consider as its own separate sequence of return risk. So we got 1, 2 sequence of return risk, the beginning of the inception of Wellington. Not a sequence of return risk if you're down 2 and 4%. Just not a sequence of return risk. Now, you can see the inflation sucks, but I guess you could say it's a sequence of return risk. I don't. But, okay, whatever. Because of inflation, we can give that a sequence of return risk. Sure. So we got 3 sequence of return risk for Wellington. Anything else? Anything? 1973 to 74, yes. Sequence of return risk. Anything else? Anything? Nope. Could you say 2008 was a sequence of return risk for Wellington? Yes, I would, because from October 2007 to March 9th of 2009, Wellington itself was down 37%. So I would consider that a sequence of return risk. Anything else? No. So basically we had, 5, 1, 2, 3, if you want to count the inflation. I think that makes sense. 3, 4, not even in 2001 and 2, and then 5 in 2007. So we had 5, and Wellington's been around since 1930, almost 100 years. It's just not that big of an issue, man. I mean, that's why you got to have at least a year cash, but I like 4 years cash because I'm a cautiously pessimistic guy. But really, you're not going to retire because sequence of return risk? Really? No. Love your thoughts. Tickle, hee, that like button. And if you haven't subscribed, what the hell? What's wrong with you, sucker? Are you a sucker? You want to go? Hold me back. We'll see you.